For the last 20-30 years, investing in India was actually a very simple story. You find good businesses with strong brand, strong distribution, good management. You hold them for a long period of time and you let compounding do its job. But if you look at what is happening today, almost every major sector in India is facing one common disruption: technology. FMCG distribution is getting disrupted by quick commerce. IT services, that has been one of the strongest sector in India for decades, is now being challenged by AI. Financial services are being reshaped by fintech. And if you look at the real innovation in technology, be it AI, robotics, semiconductor, India is way behind. On top of this, the world is facing unprecedented geopolitical conflicts. Be it Russia-Ukraine war, be it frequent issues between India and Pakistan, or be it recent Iran-US war. Such events create massive uncertainties. Especially the recent crude oil disruption is badly impacting the Indian economy, and that is clearly reflected in the Indian stock market. So all these developments in the last few years have made me realize two things. First, it is very risky to have 100% exposure in one country. You need diversification outside India. And second, it's good to have some exposure in companies that are leading the global tech innovation. So let's deep dive to understand how exactly technology is disrupting everything and how we can actually benefit by being on the right side of tech. Let's take an example of FMCG sector. For decades, FMCG companies like HUL have been a massive wealth creator. There are two big reasons behind HUL success: brand building and distribution. HUL spends hundreds of crores in brand building every year, which is not possible for new players. Likewise, HUL products are available in every nook and corner of the country. It's almost impossible for a new player to build that kind of scale. In fact, new companies won't even get a shelf space in retail stores. However, technology is challenging both the modes of HUL. First of all, the entire distribution layer has been removed. You have many D2C brands that directly supply products to end customer. And that was possible because of technology. You could simply list your product on Amazon and deliver the product to the end customer directly. Likewise, the recent rise of quick commerce has amplified the growth of hundreds of D2C brands. Clearly, technology has disrupted one of the strongest modes in FMCG sector, and that is distribution. Another example is Avenue Supermart, parent company of D-Mart. I clearly remember its IPO in 2016. A very fast growing company with crazy footfall in its store. It was also reflected in financial growth. As a result, everyone jumped in to buy D-Mart irrespective of valuation. It was a classic example of PARP investing, that is, buy at any price. However, in the last few years, its growth has reduced. And one of the biggest reasons is the rise of quick commerce companies. Today, people simply want to sit at home and order things from mobile. A massive shift in behavior that impacted one of the most sought after company in Indian investment space. As a result, D-Mart has not created any wealth for its investor in almost 5 years. Another great example of technology disruption is IT sector. For the last 2-3 decades, IT has been one of the strongest pillars of Indian economy, and companies like TCS, Infosys, HCL have created massive wealth for investors. The biggest moat of Indian IT companies was availability of talent at low cost. But now, with the rise of AI, the nature of work is changing. Tasks that earlier required large teams of developers can now be done faster, and in some cases, with significantly fewer people. Now, this does not mean IT companies will disappear, but it does raise a very important question. Will the same volume-driven growth model continue? Because earlier, growth was directly linked to adding more people, but going forward, growth would depend more on productivity, automation, and the ability to adapt to AI. So just like FMCG, even in IT, the moat is slowly shifting. Now, if you zoom out from individual sectors and look at the bigger picture, the real shift is actually happening at a much deeper level. The world is moving towards a completely new set of technologies. AI, robotics, semiconductor, advanced EV ecosystem. And these are not just incremental changes. These are foundational technologies that will define how businesses operate for the next 20-30 years. AI is changing how decisions are made, robotics is changing how work gets executed, semiconductors are becoming the backbone of every digital product, and EVs are reshaping the entire auto ecosystem. So this is not just disruption within sectors. This is a shift in the underlying architecture of the global economy. And let me be very honest, a large part of this innovation is not happening in India. And this is not a criticism, it's just the current reality. These capabilities takes decades of research, capital, and ecosystem building. Now compare this with what is happening globally, especially in the US. Some of the most critical pieces of this new technology stack are being built by companies like Nvidia, which is essentially powering the entire AI ecosystem through its chip. Then you have Alphabet, which is pushing the boundaries of AI, data, and search. And Amazon, which through its cloud infra is enabling companies across the world to actually build and deploy these technologies at scale. These companies are not just participating in the shift, they are actually defining it. And if you look at the history as well, almost every major wave of technological innovation in the last 25-30 years has largely come from the US. Whether it was the internet, search engine, social media platform, smartphone ecosystem, and now AI. The core platforms were built there, and the rest of the world adapted and built on top of them. Which essentially means that a large part of global value creation has also happened in those markets. See, let me make it very clear. India is still the fastest growing economy in the world. But if you want to be on the right side of global technological innovation, having some exposure to markets like US makes a lot of sense. Now earlier, it was very difficult to invest in US from India. But today, platforms like Vested have made it quite seamless for Indian investors to invest in global companies directly and be a part owner in the world's most innovative companies. And best part is, US market allows fractional ownership, which means we can buy US stocks for as low as $1. Now if you're not comfortable with individual stocks, you can simply buy the ETF as well. For instance, Nasdaq 100 gives exposure to top 100 companies of US, or S&P 500 gives exposure to top 500 companies of US. So technology is the first reason for diversification that we have discussed. The second reason is geopolitical risk. Today, the world is going through a phase where geopolitical tension have become far more frequent and unpredictable. Look at events like Russia-Ukraine conflict, ongoing tension between India and Pakistan, and now the recent situation in Middle East involving countries like Iran and US. Now the challenge with these events is that they don't just remain political issues. They have a very real impact on economies and markets. For example, the current disruption in crude oil supply can significantly impact a country like India, which is heavily dependent on imports. And that eventually reflects in inflation, currency movement, and even stock market performance. So if you think about it, if all your investments are concentrated in one country, then your entire portfolio is exposed to all those same risks. And in a situation where something unexpected happens, the impact on your portfolio can also be quite sharp. So even from that perspective, diversification becomes very important, because the idea is not to predict geopolitical events, which is anyway very difficult, but to ensure that your portfolio is not overly dependent on any one geography. Now the third reason is currency. If you look at the trend over the last 15-20 years, USD has almost doubled as compared to INR, which means even if the US investment delivers moderate return, the currency itself adds an additional layer of return for Indian investor. And this becomes even more important when you think of it from a portfolio perspective. When you invest globally, you are not just diversifying across companies or sectors, you are also diversifying across currencies. So in a scenario where the rupee continues to depreciate gradually over time, your global investments act as a natural hedge. Again, the idea here is not to take a call on currency in the short term, but structurally over a long period, currency movement can meaningfully impact overall returns. And that becomes the third reason why having some allocation outside India can make sense. So if you step back and look at everything that we have discussed, the idea is not that India is a weak market. In fact, India continues to be one of the fastest growing economies in the world, with strong tailwind like consumption, demographics, and financialization that can drive growth for many years. But at the same time, the world around us is also changing. Technology is becoming a much bigger driver of disruption and value creation. Then geopolitical events are becoming more frequent and unpredictable. And even currency plays a role over a long period of time. So from a portfolio perspective, relying completely on just one country may not be the most balanced approach going forward. And this has been one of my biggest learning over the last few years. So overall, 70-80% can be invested in India to benefit from domestic growth, but it's worth allocating 20-30% to global markets, especially the US, to participate in innovation, diversify risk, and also add a currency hedge. Because at the end of the day, investing is not about choosing one geography over the other. It's about building a portfolio that can perform across different environments. In case you want to invest in US market, you can explore Vested app. The entire investment process is seamless. So that's it from my side. I would love to know your take on how you see tech disrupting Indian market. I'll see you next video. Till then, take care.